How does interest rates start to affect you guys? And obviously, like the macro environment. So we know that it affects travel and things like that in general. Obviously, recessionary periods, people will just spend less, go on less vacations. All that's pretty self-explanatory. But when you start to think of the more nuanced conversation around Fed policy and interest rates, you guys use debt, and that's a huge piece of driving, outperformance here. Is it something where it's pretty tried and true and you guys are going in with like these fixed mortgages and not taking a ton of risk? Are you guys doing like interest only adjustable rate, 5-year balloon payments? Like how does this work and
All
how
the
important?
above.
Okay. All right. And how important is things like Fed interest rates moving in terms of hotels specifically?
So it's actually very important. And I think it's important in two ways. One, it's a big opportunity for us because during COVID, we raised a fund and made a tremendous amount of what's called preferred equity investments in deals. At that time, it wasn't as a result of rising interest rates, but the concept was the same. The cash flow was reduced. The owner needed to hold on to the asset. We could come in and there was an asymmetry at the time, and I think there's going to be one again, between the amount of risk we were taking relative to the reward, the return that we were getting.
Mm-hmm.
And in a hotel, you can get fixed rate debt or you can get floating rate debt. In our portfolio, we have a lot of fixed rate debt. We also have floating rate debt. It is phenomenal to see what has happened over the past 6 months. Literally, like you can have cash flow that has evaporated because it's all going to pay interest rates. There's ways that you can hedge it, which we've done and taken advantage of, which you never think those are going to pay. And now we're in an environment where those are actually paying.
And what are you guys doing there? Like what would be an example of something
So there,
you do?
as a hedge,
Yeah.
So there's something called a rate cap. So you basically buy a financial instrument that says if the Fed funds rate or SOFR, which is the rate that it's measured off of, moves above a certain level, then the counterparty will actually pay you. And if it doesn't, then you bought this thing, you paid for it up front, and you theoretically get no value from it. And historically, over the past 10 years, that's what happened. Lenders would require you to buy this stuff. It would never come into play, and you just blow it. Now, like you're actually getting a check. And recently, I had to talk to one of our investment guys because I'm like, hey, we're in this interest rate cap. Like, what do we do? How do we get the money? Like, we had to call them and see how it happened. And
hey, I know that we didn't think we were going to get paid, but actually, like, here's our bank account
we
information.
had to figure it out. Yeah, like, does it come to us or does it come to the lender? And actually, in many cases, it goes to the lender, which we didn't know. So interest rates are incredibly important. The question is, what's going to happen? Mm-hmm. So you get debt from primarily 2 or 3 different places in the hospitality world. Traditional banks, CMBS, which would be mortgage-backed securities, or maybe a debt fund. Debt funds have no problem owning your asset, whether it's a hotel or an apartment building or industrial. CMBS debt, which I'll probably never take again, is the worst because you end up dealing with what's called a servicer in Kansas who's like a 22-year-old kid who has no experience, doesn't care about you, doesn't really care about the asset, is literally just reading the words on the page, and that's how he's making decisions. And in those cases, they probably don't want to take back the asset. So we've seen certain instances where we've provided preferred equity to extend out that loan by 2 years. Compare that to a debt fund. They're like happy to own your hotel.
Is that their goal?
They say it's not, but a lot of the debt funds, that is their goal. Some of them, it's certainly not. So we've known ones that don't want to take things back and want to support you and have been tremendous to work for. Our banks have been, and our debt funds have been tremendous to work with. There are others that you can read about that are taking this stuff back now. Mm-hmm. And maybe they can do a better.
If they actually take over an asset, are they taking it over and trying to operate it, or are they just taking
well,
it
yeah,
over
they're going to
just
call my
asset
management.
sale?
Well, if they take over my friend's hotel, they're going to call me and have my management company run the hotel for them because they don't know what to do. But they're going to put an asset manager in charge. They're going to try and make these decisions, but ultimately they're going to sell it. That's really what they're going to do. Maybe they'll put in an improvement plan depending on what needs to be done. But to get back to your question, over the next year and a half, there's going to be a lot of mortgages that are coming due. And interest rates are higher. It means your borrowing power is less. So you're either going to have to pay down those loans, sell your assets, or try and extend them. So there's going to be a lot of opportunity we traditionally invest in common equity, but during COVID, we did a lot of preferred equity. So we think there's going to be a huge opportunity for preferred equity particularly with strategic partners like us who do this day in and day out.
Explain to everyone in terms of people who have heard common and preferred equity will think of tech startups, but although it's a similar concept, explain how that works exactly with the hotels.
So typically in a hotel capital structure, you have debt and you have equity. The equity that people refer to is common equity. If you have preferred equity, it comes in between the debt and the common equity. And the basic premise is that the preferred equity has to get paid back first, plus a preferred return, before the common gets any return or some return. So you're taking less risk relative to the return, but you're still an equity player, so you still have some control rights. You're not debt, so you can't just force a takeover or a sale. But what you can do, and the way that we often structure it, is we do soft pref. So we don't have to be paid like a mortgage, like mezzanine financing. We can be paid through available cash flow because we're making the bet that ultimately after 2 or 3 years, the hotel is going to be worth more than what we're currently investing in at that value. And we're going to get paid either along the way or at the end. But you as the common holder do not have to pay us, which is a huge stranglehold off their neck that other forms of financing would require, like mezzanine financing or traditional debt.